All right, everybody. Ryan Garland here, founder and chairman of Paradigm. Thank you very much for joining me today. I am beyond honored and extremely excited to introduce you to Rob Seacrest. Rob is actually my mentor. And if you guys are listening to some of my podcasts in the past, you know that I talk about this man a whole lot. So it's an honor for me to have him today because you're going to hear a little bit about my backstory and how we established our relationship. And then we're going to kind of talk deeper into what it is he's doing. I want to build awareness with my network and including my investors to have maybe participate in what it is they're doing, because not only is this guy extremely smart, but they're very strategic, and they have a deep rooted knowledge of what's happening in the game. And they've created a niche for themselves to, in essence, in my opinion, grab a monopoly on the business. So this is really kind of cool. So it's Polaris Capital Group, Rob Seacrest. He is one of the founders, and I am extremely happy that you're here. I couldn't even tell you how excited I have been that you got on the calendar, bro.
I'm very, very grateful to be here, and I am beyond happy for you of everything that you've achieved. And we've been watching what you've done and your growth. And we always knew you were going to be a force. To what level, we weren't sure. And I'm just so proud of you,
Thank you.
And your family.
That meant a lot to me when you called me the other day going, hey, man, we got to talk, And I think it was my post on LinkedIn on the Barn Caves. And you're like, that is a cool gym that he's building. I got to talk to this guy. What's he got going on?
Yeah,
that was pretty cool. Okay, so let's talk. So we met back in 2008 when I was just a young, dumb loan officer, right? Kind of coming off the '08 crash and trying to figure my way through and navigate through that. And I actually had my first son in 2008.
Yeah.
So that was a hard time for, I think, a lot of people.
Yeah.
And I remember we had a couple loans together, and like you mentioned today, I kind of got sideswiped a little bit on that one. And you guys liked me, and you're like, that poor guy got his butt kicked. So maybe we'll take him under our wing and show him the ropes a little bit.
Yeah, I think everybody was getting their asses handed to them in 2008. And but that's a part of a shakeout. It's part of the process that, real estate goes through a cycle, usually around every 10 years or so. And, you need to be prepared for those cycles when they come. We could see that you were a highly motivated person with a lot of energy. And the business seemed to be shifting around a lot. And you asked to see if you could join us. We're happy to make that happen. And we tried to harness that energy, and we got it. We got the tiger by the tail for a while. And it was a time that we were all just cranking and doing a lot of business, in trying to put those best practices in from what we learned from that great financial crisis. For us, making sure that in the next cycle, that typically what happens in those cycles is that the lenders are staffed to be originating, and if they're not originating, they can't survive.
Mm-hmm.
And if your business isn't set up in a way that you can expand and collapse to absorb those market shifts, you're going to go out of business every single time there's a market cycle. And so our philosophy was, we had gone from having 40 employees directly that were like, gosh, 20 of these people are escrow officers, and a bunch of these other people are processors and things like that. Why do we have these people on our payroll directly? Why don't we just sub out for all that stuff? So when we reimagined the structure of the company, we're like, we're only going to have the very top key employees, and everything else is going to be third parties, so that as we go through those cycles, that there is that staffing issue is able to be handled by the third parties.
And it's a perfect structure because less, as an employer, less employees is always good. Less overhead, of course, but less emotions to manage, right? So you guys went from 40 employees to what, 4?
Yeah, I think it was 3 or 4 with you.
Yeah, 4. So I was the only originator for the company. We had a processor and you and Dan.
Yeah.
So you guys, we had a lot of fun.
Yeah.
So in the beginning, I think you guys were really kind of just got done recalibrating, restructured your guys' firm. I came on and you guys were doing good, but you guys bolted me on and we just took off, man.
Yeah. If you remember at that time, Dan is my best friend and co-founder and my mentor. And I don't know if you remember, but in reality, what Dan had created is he had financially engineered a new product.
Mm-hmm.
The idea that Dan had was, there's all of these qualified builders out there that have been completely wiped out by the great financial crisis.
Mhm.
And we were trying to think, what could we do for these families and their businesses to get them stood back up? You've got idle people, and you have the most opportune time to take advantage of projects out
And they
there.
have talent.
They have talent. We already knew who they were, but they didn't have any capital.
Hmm.
And with private money lending, you've got to come in with typically 30 to 40% of the equity that you need to close that, and they didn't have that. And so what Dan did was very strategic, is that we created a new financial structure that hadn't been done before. And what we did is that we did a private lending model where all the borrower had to come up with was the earnest money deposit and to get the property tied up. So what we did is we teamed up with a hedge fund, and we did a product where our company, us, did the entire transaction, but we broke it into an A-B piece. The A piece being the senior piece, which was the loan piece, which was ours, that we raised the capital. So we lent to 50% future value,
Hmm.
and we had a hedge fund came in behind us and put in the equity on behalf of the borrower. And so we pre-funded the interest reserve, and the equity fund did a profit split with the borrower. And I don't know if you remember, but
Mhm.
that product was the first one to be put together.
You, in essence, built like a Class A, Class B slug, is what you did.
That's what we did, and that
Mhm.
was that 25102F, and that's
Mhm.
where we started utilizing that structure, because it was really important to the hedge fund, because it was one senior loan recorded that went up to 70% of the ARV after repaired value, but our A piece was only 50%, so our
Mhm.
investors loved it. But the hedge fund was able to sell it to their investors as a senior secured, but the B piece in there, and they loved it, and we crushed it with that product, and that started the whole evolution of everything that we did.
So let me just kind of give our audience a little color, right? So when back in the day, for those of you that used to watch Fix or Flop, and Armando Montalongo, the Hispanic guy that had the what was it, the F or the Hummer, right? And he was flipping properties in Texas. And then you have a lot of these other what's some of the other Bigger Pockets. There was a lot
Yep.
of these other
Mhm.
groups out there that were saying, hey, you could do 100% financing as a flipper, that type of stuff. That'll give you guys an idea. Dan and Rob were the ones that tailored that 100% financing
We were
product.
the ones that did it.
So when you saw all these fixers and flippers go out there and do it, we actually had that product first, and that's why we became the top producers literally in the state. I mean, we were crushing it.
So that product became a product
Mhm.
throughout the whole industry. And
Yeah.
many, many times. So one of Dan's best gifts that he has is financially structuring products. And
Mhm.
so we basically say, capital is kind of like water. As the markets change, it just flows to where it needs to land next.
Mhm.
That's just the imagination of recreating financial products that work for that period of
Yeah.
time.
And just to kind of give you additional, so at that time when you guys created that, you gave me a product to, in essence, go sell and build awareness on, right? And educate, like you like to say. So I was going out and speaking at all these events, and what I ended up doing was figuring out a way to get in on the Armando Montalongo coaching system, where they would have all of these investors across the country would pay to be a part of a coaching system. They would have bus tours that would come up to California. I had a relationship with the broker that built the relationship with the coaching company. And we'd have, every 3 months or so, 300 people on bus tours coming through. And I was the only, loan officer coming through there. And then they were, obviously offering to their students that a lender like us would be there and that we can actually provide 100% financing. So you could only imagine, for my audience right now listening, how insane that it was that after 2008, when there was a bottleneck of capital, where you have a firm that figured out a way to do 100% financing to catch that swing on the way up in the market. So with that type of awareness and me being able to get into, like Nick Manfredi, he had a big coaching system in Corona. He had, I don't even know, a couple thousand people in that system. So I was able to get in front of a lot of borrowers.
What made us most proud is all these operations were able to get operational again in these families and
Right.
their subs, and there needed to be somebody that kicked this off, because a bank, that is not something a bank could do.
It's always gonna be private capital.
And these families, that's their skill set, and there was no other place to flip out to. They could go do a building for somebody else, but that's not going to support their whole family and give them the equity upside that they needed. So
Yep.
And there was massive upside in those projects back then. So the profit split was if you could flip it in 90 days, they got 70% of the profit. I mean, it was awesome.
It's a big deal. And, you're in some cases you're like doubling your money. It was pretty
Well,
impressive.
the ROI on their money was unlimited
Yeah.
because they would actually get their earnest money deposit back out at the end.
Exactly. Yeah, absolutely. Because that was a first in, kind of first out
Yeah,
kind of thing. Yeah, for them. Yeah, that was pretty cool. Okay, so let's talk about really the whole point for you to be here today. Let's talk a little bit about what the firm has morphed into.
Sure.
I think I left right around 2014, kind of started my own brand, Paradigm. And then you guys saw an opportunity and you
Sure.
hung your hat on it. So let's talk about that.
So Dan is always researching and looking at where the opportunities are in lending sector. And in 2014, our local congressman Dana Rohrabacher passed the Rohrabacher-Blumenauer Amendment, and that amendment defunded the Department of Justice from any prosecution of a cannabis-related transaction. And Dan came to me one day and he said, "Buddy, we're going to start doing cannabis loans." And I looked at him, and so the way that we run the company is I raise the capital, and Dan does the underwriting of the transaction. And the first thing I thought to myself, this is going to be impossible to raise money for it. For many things. Back then in 2014, the stigma around cannabis was a different place than today. And there's just so many things that before we could ever even talk to an investor, they had already in their minds turned off.
Anything has to do with
It's not
marijuana.
they don't want to be associated with it. And so when he told me that, I'm like, oh, great, this is going to be impossible to do. But that passed in 2014. We started researching it. Dan is meticulous on how he thinks about things, and so just raising the capital is only one element. You need to make sure that the processes and all the elements are there. Is the title company able to work with us? Can we make sure that the title company records that this is a cannabis transaction so they don't honor our title claim if we had to have one? All of those things he worked out, and then by 2016 we started originating our first transactions, and it really was the beginning of a new era for our company and what we were doing. And ultimately, we launched a fund in 2018 specifically focused on lending to cannabis sector commercial real estate. And that fund, today, we've done more than $500 million with that fund. And then we also recently launched an equity fund, which is what we're kind of here to talk about.
So don't go too far yet. So this is what's kind of wild because, and I'm just going to kind of give a lot of my audience are actually pretty deep rooted in finance and development, and they understand what exactly it is we're about to say. But as a private lender, I have my debt fund. And so I'd have developers and borrowers come to me all the time going, hey, can you lend me money on this commercial building? And it is going to be for, a grow op or what have you. And I would say, no, I'm sorry, I can't do that. Right. Even if you have your license. So I would actually pass on it. And most of the times those borrowers could not get bank finance. That's for sure. So they come to alternatives, guys like me. And even I was saying no to it. So you guys found a niche, which is not surprising whatsoever, right? Given your track record. But let's talk about how you structured that, because I think that's going to overlay kind of where you're going to end up sharing here.
Sure. So in the beginning, it's a brand new emerging sector. Nobody has done it. And so it's a learning curve, and we're trying to use all the best practices that we've developed over doing thousands of transactions, more than $1 billion in transactions that we've previously done for not related to cannabis. We're taking all those best practices, but we're trying to layer in the nuances that would need to be in this sector. And so in the beginning, we would lend on the real estate value of the cost basis of the transaction. But in the beginning, we didn't cross-collateralize the license from the tenant, which may or may not be related.
Real quick, before I don't want to interrupt, let's just to go deeper into the weeds on cross-collateralizing. When you say you lent on the cost basis, just for our audience to understand, is it the cost basis of the building or both the building and the business?
Yeah, so I'm really glad that you delineated that. So we only lent on the cost basis of the real estate.
Right.
And so back at that time, because of where we came from, we just never thought about the business or collateralizing that, because in a normal lending world, you would never be able to get
Mm-mm.
that. Nobody would ever give you, and it may not even be a related party. So you can't, they would say, we don't have anything to do with this loan.
Yeah. So
But
it'd be the owner of the building wants to lease out that to a tenant that
Mhm.
is going to
Right.
grow up. Right.
Yeah.
So they weren't related. Correct.
Right.
Yep.
But in how Dan was thinking through all this stuff is he's like, we had lent the first transaction we did. I mean, free and clear property. The guy paid cash for it. It's a construction loan for $1 million. We only advanced after the guy had made the initial spend, and then we verified it and we reimbursed him.
Yep.
We cross collateralized his Bayfront house in San Diego. I mean, you couldn't be any more secure. So, but ultimately, Dan realized that we really need to make sure, because it's a specialty use asset. And really, when you say alternative use, the alternative use is just an alternative user of the same. You're never going to not have a cannabis property. I shouldn't say never. You're 99% of the time not going to have a cannabis property that's going to be repositioned for somebody else, unless it's just a dispensary or something like that.
And let me share a little further. I'm sorry, I don't want to interrupt, but I want everybody to get a very clear understanding of how much in depth you guys had to work through this stuff, because the war wounds that we talked about yesterday, I have to touch on. So when you say a special purpose building, ultimately it's a building that's being built for cannabis. So ultimately, it's not like the building's like a regular retail building or some sort of single family home where you have comps. I mean, this is totally different. It's designed for the right water, the right electrical, the right power, right? A certain space where you can have all of that stuff, drainage, right? All of that stuff has to be customed.
No windows.
No windows, yeah. So totally, like a totally freaked in weird building, right? But it's designed for that. So so it's really hard to comp. And then two, if you were to foreclose, you have to spend millions of dollars in some cases to repurpose the building to be to the open,
So
market.
On that point, so when we would get we'd get an appraisal, as is future value, non-cannabis value and cannabis value. But the thing that was ironic is that the non-cannabis comps never included what it would actually cost to decommission it to
Mhm.
get it to that. And so we always kind of internally, like, really, like,
Where do you go? Who comes up with the numbers?
you're like, okay,
Yeah.
so this building theoretically could be this size building, square footage in this area could be a self-storage. Well, to get it to be self-storage, you would have to come in and tear out every single wall, every air conditioning duct, everything that's in this all the water piping, everything that is in there, all the ADA compliant trays to moving the cannabis across the rooms, and you would have to. It would cost you millions of dollars.
Yeah.
It would be more. You might
More
as
than
well
sometimes the
flatten-
building would be. Yeah. But it'd be easier to just tear down the building and rebuild at some
Yeah.
point. Yeah, for sure. So that's the point is, the risk that goes involved. And then obviously even, I think you probably even had issues with appraisers. How do appraisers even appraise something that they don't know
Yeah,
that's new? So I'm sure I can only imagine every layer has been something. Yeah.
Every layer, we had to educate people on what was happening and what they were doing, and continue to refine best practices and make sure that they are. There wasn't the data, and so we actually had to create a whole nother data company, Flourish Data Project, that would effectively be the co-star of cannabis lending commercial properties, because nobody had any of that data. Nobody was producing it, and yet we had thousands of loans that were flowing through to us, and we were capturing that so that we could get the market comps, we could get the lease rates, but no appraiser had that because it wasn't public anywhere. So the only way they'd ever have that is if they happened to have done another transaction remotely in the area, but that would have been stale.
But you're the ones that are doing more of the transactions by
Way
far
more.
than any other
More.
appraiser. So you're almost educating them on how to do it. Yeah.
So we would have to provide data comps and information, but also when we would get transactions from other borrowers and their appraisals, we had all the data to dig into that and basically validate it or disprove it.
Yeah, gotcha. So again, layer after layer after layer. Okay, so you get through your first one, and how much capital did you guys raise, and then what was your AUM the first year?
So
And you said this is 16.
yeah, so when
Yeah.
we first started doing transactions, we were syndicating transactions just to get a feel for it
Mhm.
and doing deal by deal. Once we got a feel for it, then we pivoted to launching a fund. And then the fund was taking a small piece to get diversification, and we're still syndicating. the plan was always to get to the fund being just the sole vehicle. So in the first year, 2018, it was just a partial year. We only had about 1.65 million. So Dan and I are putting in millions and millions of dollars so that all the infrastructure and the operations are set up for, a $250 million fund or whatever it was planning on being at that time. But the income wasn't there to support it. So we were supporting all that. The next year, we got up to 6.5 million. The reason that it was such a struggle is that there was no investor that existed for this type of product yet. You had either people that were willing to do cannabis at the time were only equity, and they were doing equity-like returns, and there wasn't
into the business, but not necessarily a real estate fund.
and
Yeah.
there wasn't any private credit fund specially focused on cannabis, and so and just the morality part of a lot of people, we never got a chance to explain to them, look, we are actually helping this sector. This is not for kids. This is licensed. This is getting rid of the illegal market. Would you not lend would you have that same issue with the lending to a drugstore, a CVS that sells opiates?
Yeah, that's a good way to think about it, man.
And so, when we could quickly deconflict what their issues were when we had a chance to talk to them.
Yeah.
But 99% of the time, we didn't have a chance to talk to them because they're like, no, I just don't want to do that. But then we started posting our returns, and the returns were phenomenal.
Yeah.
I mean, ridiculous. And so then people started saying, well, look, maybe I'll look at this. And then COVID happened in 2020. And I also converted the fund from being a standard fund to a private mortgage REIT for the tax savings. And that also was really important because the investors, what most people don't understand about a REIT is it's one thing to have the qualified business classification to reduce your taxability on the income. But in reality, that's not the most important thing. The most important thing is that individual investors are only taxed in their state. So even though we're doing business all throughout the country and domiciled in California, you're not going to get a K-1 from California, which is awesome.
It's huge, yeah.
And so that was really important. And so that allowed us to start bringing in investors in low tax state or no tax states, and it just took off. And then COVID was really the genesis of where it really took off for a couple of reasons. One, cannabis was considered a I forget the name, emergency business, or where it could be open. I forget the terminology. I'll come back to it in a minute. But more importantly, as all other sectors of real estate were protecting the tenants, they didn't have to pay. You couldn't evict them, and nobody was coming to work anymore. And commercial real estate was faltering. Our sector was exploding. In our sector, what I realized is that the way to most distinctly articulate it is everybody is invested directly or indirectly in a real estate asset class, whether it's through your broker dealer, your asset managers, or whoever it is. And what we said is that, look, whatever your allocation is, a certain portion of that allocation should be allocated to a specialty asset class that is less impacted in a real estate or economic downturn. And that, when people started thinking about it from that perspective, and I switched the fund from being quarterly distributions to monthly distributions, I did everything I could to make it as retail friendly as possible. That year, we ended up at 54 million. The next year at 150 million. The next year, 250 million. We got up to like 440 million or something like that.
So you guys just cranked.
Yeah.
And so let's talk about the positioning of that those assets now and where you plan on going, because we can go down rabbit hole after rabbit hole. But I think really this is the fruit. This is what I want people to know is right what we're about to get into, because this is impressive.
So going back to that part where we lent on the value of the real estate, and we cross-collateralized the businesses, the licenses, the brands, the equipment, everything. But we never gave that value. And our thesis was, if things really hit the wall and we have to take this property back, and if we can't find a third party to operate it, we may have to operate it ourselves. And if we have to operate it ourselves, we better have the licenses, because in reality, there is no alternative use that most likely it's not going to pencil.
Right.
And so as years went on and the markets changed, and some states are unlimited license like California and Michigan, and other states are limited licenses like Florida and Illinois. There's a different market dynamic in a unlimited license state. That's the best for the consumer because you're getting the highest quality product at the lowest price. In limited license states, because of the regulatory capture in those states, you're not necessarily getting the best product because you have an artificial barrier that is keeping the prices up and is protecting those people from having best practices that would put them out of business if they were competing in an unlimited license state. So ultimately, as each state is its own market, you can't cross state lines. And as these states are going through what we call their maturation process, of the state opens up, it's everybody comes in, and anybody can grow weed, and it can be the worst weed in the planet, and you can sell it for thousands of dollars a pound. Within typically the cycle is usually within about 18 months to 24 months, the quality starts to get better, the consumers start become more educated, and the people that came in that really didn't know what they were doing, but they could sell anything, they go out of business.
Right.
And so the market, it's a normal cycle.
And it's happening right now.
We see it every time in each state, and as each state comes online. And so as that happens, though, some of those people are going to fail. Now, the industry or the sector is doing very well. The numbers of the income, it's about a $40 billion annual industry across the whole country. That demand is not going down. It's just where that revenue flows to, whether those businesses can be profitable or not. And as they fail, that profit or that income goes to somebody else, and hopefully they can be profitable. And so where we're at today is...
So the demand doesn't change. It's just like banks. As banks start collapsing and you get smaller and smaller banks, those banks are now getting more and more depositors, right? Same concept.
So ultimately, unfortunately, we had several transactions that ultimately couldn't compete and were wiped out. And there's only so far as a lender you can go to try to help them through it. Now, if we have a good actor, borrower that's trying to do the right thing, we have more latitude that we're willing to go to in that circumstance. If it's a bad actor, we want to shut that down as quickly as possible and move on to the next cycle of where we're going to go with that property. Over time, we ended up not foreclosing because, remember, we not only captured the business, the real estate, which would be a foreclosure, but a foreclosure would not capture the cross collateral. So the cross collateral, you have the option of potentially an Article 9 sale, but that's not is the best. The best is a receivership. So a receivership is the same as a bankruptcy, but at the state level. And so what we would do is put them into receivership, and then we would effectively wipe the entire capital stack, all liabilities for not only the real estate, but the brands, the businesses, and everything. And now we owned everything free and clear. And at that point, we would then try to find a third party to step into that transaction. If we were unsuccessful in finding a third party, or if we're going to have to put all the money up for that third party to come in, then we might as well get the equity upside. So what ended up happening is that of these transactions that we unfortunately had to take back, some of the businesses became unbelievable opportunities when our team looked at it and really dug into it. And we can get into some of that when you're ready. But it really has morphed into where we ended up having to create a whole new fund to capture the opportunity. So just like when we started off the podcast, we were talking about 2009 and the great financial crisis and the reset and all that opportunity. We're in the same period right now in this sector, but the upside to the investors is orders of magnitude isn't even the right word relative to what it was on that side. And so previously that upside was going primarily to the borrower and the hedge fund. Today, we've been able to model that where all the upside comes to our investors.
So let's talk about this. So the structure. So you lend money on the cost basis of the building, right, or the real estate, but you're encumbering all of the business components too, including the license that was issued for the cannabis or whatever that practice is for that building,
right?
Because it's non-transferable, and we talked about this too. So you in essence acquire that. I love how you go into receivership. You wipe out any of the capital stack, and in basic, it's free and clear. And then you, in essence, are doing what I would say standard practice of a PE roll up, where you guys come in, you already have back office, you can look at the books and records and start shaving costs for overhead
Mhm.
and get that thing to turn up to more profit, and then bring in other practices to actually get it to produce
Yeah.
more, whatever it is that you're doing. How many? Let's talk about your big picture. Where you are now? How many assets you've ended up having to acquire back? Which I know the number, but it's such an impressive number. And then kind of how this has ended up morphing, because that's really what it comes down to. I tell my team all the time, there's a reason I named the company Paradigm, right? You have to shift when the market shifts, and sometimes you don't see the opportunity when you created the fund. The opportunity presents itself later on, and usually through hardship or distressed situations. And so that's what I think has turned up with you guys.
Yeah. So, I always say that your best asset managers are the ones that have been through distress. That's what tests the mettle of an asset manager. And if they've never been through it, it's easy to say that you crush it. Show me a guy that's been through 2 down cycles and what they learned, because that's where you really learned. The workout's the tough part. Just originating and everything going fine is easy peasy. Those workouts is where you have to put in
Totally.
the work. So we ended up taking back about 140 million of assets, and those assets were all taken back on the cost basis of the real estate. We spun all those assets out and launched a new fund. The cross collateral of all the businesses we never valued. So the new fund was seeded at the cost basis, 100%, no discount on those. And now we are marking all the values of the businesses.
So let's just kind of dumb it down even further. You open up $1 billion fund, because that's the offering, right? You open up $1 billion fund. You guys are seeding it with existing real estate that you've already foreclosed and take back that is debt free. And you're putting $140 million, seeding that with an assets that, in essence, whatever you're doing can either cash flow, but there's already equity, and now the investors are coming into the new fund to advance that strategy.
So in the new equity fund, the Polaris Growth Fund, it got the real estate or the businesses or both, but the businesses were in that new fund. So those businesses we hadn't given any value yet. So we can talk about how that works out and how we do that, but that structure and those assets became the ecosystem that we then used to execute on the bigger strategy. So
No, sorry. The businesses, let's just, because what you've done is you guys separated the real estate and the businesses. You guys, from a different hat, in essence, you guys are coming over here with your team and you guys are converting those businesses into positive. So for example, you said you had one that was losing $1 million a month. Now you got it back to $1 million positive a month. So as you guys continue to scale that, and you now those businesses are generating income. So now that evaluation's different, but then you bolt on real estate, then you bolt on tax strategy, then you bolt on all this stuff. So as our audience can imagine how far this can go. So keep going, please.
Sure. So I'll give you one transaction that is the 9th largest operator vertically integrated in California. It was a company called State House. And the thesis was right. It was to merge 3 companies together to become vertically integrated. In California is the most competitive market, and it's the largest market in the world. And it is, unbelievably competitive. And so unless you're vertically integrated with scale, you're not going to be able to compete in that state. And so we originated a $77.3 million loan secured by a portfolio of $110 million of real estate. We cross-collateralized the company. Ultimately, we put that company in receivership. They weren't able to integrate the company, the merger together. They weren't able to get those cultures.
And what were those cultures?
It was cultivation, dispensary, and manufacturing. So it's 3 different ecosystems.
Pretty much everything you need.
Yeah, and it was unfortunate. The right strategy, just the execution wasn't completed. We put in receivership last year. Our team is very strategic of how we set up the receivership. It's actually part of the core tenet to make sure that you don't lose the company in receivership. And so, I'll give you an example of how ours worked and another one that didn't, but that somebody else ran. But that in that receivership, we were able to take that company from losing $1 million a month to making $1 million a month. We didn't lose any top line revenue. We were able to grow at 2% over year growth, while the state itself decreased by 15%. So we had a 17% net positive gain while in receivership. And we went to the top creditor, credit risk of the entire state. And we turned around everything and got that company operational, cash flow positive, EBITDA positive, and ended the year at 106 million top line revenue, and I think about $8 million EBITDA. And the only reason it was only 8 million is that we still had some losses that we were turning it around from when we got it in May.
So just so we're clear, you went from losing $1 million to making $1 million, right?
For the business level.
For just the business level, which now is $106 million. You said $106 million a year. Okay, that's separate than that $77 million in real estate that was valued at $110 million. That's a whole nother ballgame.
So the way that we think about it, and this is a perfect transaction, is to really walk through why those licenses and everything is so important. The 6 pieces of real estate that were valued at 110 million, without this company operating those, there is nobody that is going to step in and operate it. So our value of our collateral would have been wiped out. There's some alternative uses. We might have been able to get some percentage of.
So again, the building itself was designed for this. Yeah. So the part of the conversation in the beginning was like, we'd have to repurpose the building, spend millions, and you'd be losing money. There's no way. No offense, bunch.
Yeah. So
lots of it.
The thesis was to stand up that business and get it operating, and that's stabilize our real estate. So today, that real estate is valued at 100 million, and so our we're net positive just there alone. But we picked up the business. And so the business now, we own not only the business, but all the brands. And it also had a portfolio of dispensaries that wasn't even part of our collateral. It had brands that weren't part of our collateral. All of that we brought in. And so that strategic hub model is one of our 4 strategies that we implement across the country. As what we did for our own credit fund, we're doing for other asset managers and creditors across the country. So we had to do it for ourselves, but we realized that all creditors are going to need this. Most of them can't actually even own the real estate directly, and they for sure can't own the cannabis business or operate it. So the thesis was, let's get it stand up for our stuff. Let's build the ecosystem, and then let's go out and track every receivership across the country, and let's look and see what assets are complementary using our data project. And if it's an asset that's complementary, all the creditors know who we are. We come into those creditors and we already know if they can even own the asset directly or not. And I'll give you an example. So we went to one that was doing a receivership of a company in California about the same size as State House. And we got the creditors to assign their credit rights to us. So we could foreclose on their behalf. If it reverted back, then they could do a seller carryback and we would be able to acquire that transaction for nothing down. They're happy because they didn't have to take a loss, and we can hold it from them, and then we can operate it for them.
So let's unpack this, because this is important. This is probably one of the most important. So I'll use it as an example of 08, right? When all those short sales and REOs hit the market, the banks internally, asset managers had no idea how to oversee them, right? So they had to figure out ways to create sectors. They couldn't, that's why they were offloading a lot of these assets to fix and flippers and working with brokers, and they had REO agents and so forth. But they didn't have the team internally to manage it. That's why they were always outsourcing it. Same concept. All of these lenders were lending, a lot of lenders were lending on these assets. But once they took them back in a distressed market, right, which they are in right now, they don't know how to repurpose it, and they're about to lose their butt, like you said. And they definitely don't know how to operate, nor can they own it. So what's happening is you guys are identifying those assets. You guys are going after those lenders, in essence, saying, hey, we'll work with you. Give us the opportunity to take over the foreclosure, in essence. We'll come in and repurpose the asset, and then you guys get back to a positive on your books.
That's correct, but there's more to it than that. And we
I'm
talked
sure.
a little bit about last night. So as a fund manager, when you start to go into a distressed transaction, you're now having to adjust your loan loss reserves for that specific transaction. And if it's becoming distressed, the value's coming down. And then you're starting to do comps, and theoretically, you should be adjusting your value as quickly as possible to increase the reserve if you have to liquidate. If that property comes back to you, let's just say that let's just say it was a loan that you did for $10 million on let's just say, to make numbers easy, on a $20 million valuation. But the borrower failed and they're foreclosing on it, and the best prices out there right now is only 5 million for that same
It's
property.
a $5 million loss.
It would be a 5 million write down.
Yeah.
So they would be increasing their reserves on that. Now, if I can come in and I can restabilize that real estate and stand up a business so that it's back to its original use, all they have to do is get back to the 10 million. If I can get them back there and I can show them a path through, they can release that $5 million reserve. If we do a seller carryback for the whole thing,
Mm-hmm.
we can clear $5 million off of their unrealized loss reserve. That's massive.
Oh yeah.
That is an immediate uplift for their investors.
Yep.
And so that right there is something that you wouldn't really think about as a retail investor of unless it's negatively impacting you. And we've had to deal with this ourselves as well. But we realize that this is something that the asset managers need relief on as well, because without they're getting this maximum price disparity in where they're having to reserve for. And if we can get them back out whole or closer to whole, then that reserve can be released once the transaction has been completed, and it's a better situation for everybody.
It's a win-win. And you guys are in essence popping up more businesses, which generates more income, which is a part of your overall strategy. You're helping the bank, basically not lose any money, along with the investors that are back there. So the fund managers are going to be very open-minded to making this happen.
We're talking because we're in the investor ecosystem, but in reality, we're employing thousands of people across the country right now, and those jobs are important to us. We want to keep this country stabilized. We want to keep this industry stabilized, and so it really is important to create an ecosystem where you can save as many jobs as possible, and we don't want to see people get wiped out. We want to try to save where we can, what we can, for giving some optionality for people to recover as best as they can. So we think that we found the best way possible in a specialty asset sector. That's not always true. I'll give you, specialty asset is something like movie theaters. There's only one use for that theater. And as the markets start to change and people aren't going to the theaters anymore, you've got all these theaters that are idle, that are probably not making money or making very little money right now. And who knows if that's going to get turned around. And so how are you going to reposition? How are you going to, we have the same thing. It's just a different class, and we've got a better way through.
Well, I got to tell you a story. So right here in Lake Havasu, so I don't know, 200 yards from us is the North Side Mall, right? So the shops or whatever they call it. So the movie theater was having a hard time, and they actually, in essence, separated a part of the theater and opened up a Buffalo Wild Wings in there. So they actually took up some of the actual movie theater and built a Buffalo Wild Wings. So that's how they repurposed that building. They still have some of it is left for movies, and the other is now a restaurant.
So, in a traditional bank, you don't have anybody that can make those. You might have somebody that comes up with the idea, but to get that all the way approved and to think, the banks just sell those properties off. And nobody's really working it.
Mm-hmm.
We are freaking working every single option, and some reiterating and it starts to grow. Once you start to come up with strategies, then you can start to expand that strategy across the country. So back to State House, in that particular transaction, we realized that we had a strategic hub model that we could now take other assets that we had taken back in the state and start adding them complementary to that ecosystem. And so we believe that we can get from number 9 to number 4 within the next probably 90 days in the entire state. And
Wow.
If there is about 1,500 dispensaries in the state of California, and State House is currently in, I think, like 400 or 500 of them that they're selling their product, but we own 12. We've just contributed another one. We own 13. Why that's important is how many you own is that your margins on your own branded products are about double what they would be if you were selling in another store. And so every single dispensary that is out there that is a standalone dispensary on its own, they don't have the buying power that we have. They don't have the cost savings of the management, and they certainly don't have the ability to bring in their own vertically integrated products, branded products onto their shelf space and pick up that double the margins. And so with just those 3 elements that I just shared with you, we can take a standalone dispensary, laterally move it into our ecosystem, and we can increased the EBITDA profitability by 27%. And we can acquire that dispensary. I just happen to know the figures and off the top of my head. The one that we just contributed was about $7 million of top line revenue. It was doing about 655 of net annual EBITDA revenue. And that transaction those are trading at 1 to 2 times multiple. If we use 2 times multiple, roughly $1.3 million cost basis, we could effectively give that dispensary 1.3 million of shares in our fund, because without us being there, they're going to go out of business, because we're going to, if it's not them, we'll do the dispensary next to them. We can take that dispensary and take it by adding those 3 elements that I just shared, and take the profitability up to, I think it was 2.2 million or so. And now, because it's in our vertically integrated ecosystem, the multiple is 4.5. So we just picked up that same store, I think, would be around 7 million or something like that. I can't remember off the top of my head. And I think we net about 6 million enterprise value to the fund from one dispensary. And we increased the revenue from 655 by over $1 million.
And so not all these dispensaries actually have real estate holdings, but some of them do, right?
Well, we don't need we only actually need the business. We don't even need the real estate.
Yeah.
So the whole dynamics change,
Right.
Interestingly enough. And so if we're out there to add, 100 dispensaries in the next 6 to 12 months, if we just use those same numbers, that's 700 million of additional top line revenue and hundreds of millions of net EBITDA positive. And we're just going to keep picking up economies of scale. And so that's why when we launched the growth fund, we did $1 billion offering, and a lot of people said, how are you going to raise $1 billion of equity? Well, we're going to raise equity as we go, but we don't need a whole lot of cash. We're actually going to be using the shares as one of the ways of acquiring something. So if you're that seller of that dispensary, and there's no buyers out there, not only can you contribute, but you're getting yield you're participating in the upside of what you just contributed.
Yeah, and they keep their business. They keep the employees.
We could give them a cash offer, but it's certainly not going to be full price.
Yeah, right. You're giving them full price for the most part on what they're already making. And then you come in and, like you said, you bolt on some of your guys' infrastructure, your guys' product. You guys are covering back office and starting to shave down their overhead.
Yes.
And now you're seeing it create revenue. That bolts on to your guys' portfolio. And now they get shares on the overall exit strategy of this project or this entire operation.
So that's just one of several strategies that we have that, some of the stuff we don't want to talk about all the things, because it is a massive opportunity. And again, we're leading it in this sector right now, but
can't tell all your secrets.
There's other asset managers that are going to be executing on the similar strategy, but we're pretty far ahead of them, I think.
Right on. Okay, so let's talk about the fund and the opportunity here. So let's go back to seeding the fund, the $1 billion fund. What's that look like? What are we trying to accomplish? What's the next move?
Yeah, so we seeded it with 140 million. We're actually waiting for our third-party reports to give the valuations to the businesses right now. I don't have that value, but we didn't pay anything for them, so it's going to be net positive. And each acquisition that we do now going forward will be at a much higher value increase to the fund, because the first assets that we acquired it at 100% of the cost basis of the real estate. That's the first and only time that we'll ever do that, because it was our own existing fund. Going forward, we will acquire stuff that's not our stuff, and we will get those at discounts or use our shares or many different strategies that we're going to use. So the fund is structured as an open-ended evergreen fund, 2% asset management fee, and 8% pref with an 80-20 split. We do quarterly statements, and this strategy is not an income fund. This is a growth fund. So what we're trying to do is maximize all the revenue, everything that we have, we're reinvesting into the business. And so this strategy is, if you put in 100,000, we're looking to get you a 4 to 5 times multiple in 4 to 5 years. So that's our target within the current legislative landscape structure right now, which is a 20 to 25% targeted net IRR yield. But I think that we are hopeful that we can outpace that. The current landscape in the country is, because cannabis is federally illegal, cannabis is currently considered a Schedule I drug, meaning that it's the same as heroin. There's no medical use for it. And why I'm going down this road is it's really important to know that on your federal taxes for all 25,000 businesses, we track them all across the entire country, on their federal tax returns, they're paying taxes on their gross profit, not their net profit. And imagine having to not be able to write off your deductions and having to pay it on the gross profit. It's insane. So under the Biden administration, about 2.5 years ago, Biden requested the HHS go and look at rescheduling cannabis from Schedule I to Schedule III, meaning that there's a medical use for it. That HHS came back and approved that, and now it's with the DEA to be approved. Trump has already many times indicated that he would sign it if it got to his desk, but this is actually, rescheduling is only in the executive branch, and there is no Congress involved. And so this is really important to understand the distinction here. So right now, rescheduling is at the DEA, and we're expecting Pam Bondi to most likely give the final rule sometime in 2026. Why that matters is that once that is approved, now the IRS will only charge taxes on net profits. And so we expect there to be a 20 to 30% uplift to the bottom line of all businesses across the country on a revenue basis. But more importantly, the multiples is going to go from a 4 to 5 times multiple to an 8 to 10.
So this it's just unlocking more opportunity for investors is what's happening, or for the industry overall.
So our position is you need to be able to, your business needs to work in the current ecosystem. And if it doesn't work you can't depend on legislation or executive orders or executive actions to fix your business. If you can't compete successfully now, then it's not going to work.
Yep.
But there are some things that could give us some significant enhancement, which we're pretty bullish on those happening at some time in the future.
Okay, so going back to the fund, so you guys open up $1 billion offering. You guys are taking assets that you guys have already repurposed and now, in essence, generating income. You're on the growth strategy. You're putting $140 million into this fund to show proof of concept that you guys have skin in the game, and now you guys are going after raising capital. And it sounds like you're going to do it at a pace where, as you guys have new assets that you guys are identifying, you are then strategically positioning those assets on your guys' strategy, whether it's, dealing with certain infrastructure, bringing in your product, whatever it is. Because every dispensary and every business has its own culture that you have to go identify and where they're missing, what they're missing, where you can do to help. Once you've identified what can be done, you're then identifying that to the investors, putting it into basically, hey, here's another option that we're going to go after and buy, and this is what your projections are going to be after X amount of time.
Kind of, but we can't tell the investors in advance. It's privileged information.
Sure.
So they will find out when we close on the stuff. So some of the things that we're working on are publicly traded companies, and so it's not a standalone transactions where we have that opportunity to share that. We would make our announcements in our quarterly reports and or publicly to certain things we're going to announce publicly. Certain things are only going to be disclosed internally. So there's things that you and I discussed last night that are not proof of concepts, fully eliminated 100% of execution risk of some things that are game changers for the whole entire country. And unfortunately, we can't share that yet because we have the first mover advantage. And when that becomes discovered, it's going to be a race to figure out how we did it.
Yeah.
And that's a whole nother asset that we figured out. And I can talk a little bit about that asset if you want.
I just said everybody, so we're clear. At least I know, though.
Yeah.
I know the real truth.
Yeah. So the entire cannabis industry is federally illegal, but state-wise legal in the states that have approved it. And so what retail investors in this industry, they don't follow this, so they don't know. There is another landscape of licensing, and it's at the federal level, and nobody knows that this exists. And so there is a research license that the DEA has that has been around for, I think, over 40 years, where the University of Mississippi had a DEA license issued to them for research. And so there was one cultivation license issued to the University of Mississippi, and then there was several. I don't even know at the time if there was any research or if they were just doing it themselves. And I should know this, but I don't know it. I'll maybe we can edit it back in. But some legislation passed where they actually part of the legislation was to increase the universe of research on cannabis at the federal level. And what that did was it changed. There was going to be a total of 7 cultivation licenses approved, and there was going to be only cannabis cultivated for research in the federal ecosystem. So this is not going to be for retail; it is only for research.
Mhm.
But now that is the genesis of where you get to have drug companies and start doing studies at GMP certified facilities and the quality that needs to be, and also research cannabis is developed in a different pathway than recreational. Recreational is for how good it smells, how the high is, yields. Cannabis research is specifically not for yield, not for smell, not for any of that. Is to target what it is that you're trying to have resolved.
Yeah.
And so
Medically, yeah.
it's a totally separate track.
Right.
And people don't. When you think about it, it makes sense. But
How,
until
how
I
to
say that,
consume it, how they're going to, yeah,
how-
all of that stuff.
it's going to be a pill. It's going to be a different form factor. And so
IVs. I mean, there's so many different things that can be done. Used.
and so in that universe or that ecosystem, it's to just only produce cannabis to sell within those research labs across the country. It's a very profitable market. It's a great market. But what we were trying to do and what we were working on is one of our borrowers had one of these licenses. Unfortunately, we had to foreclose on that facility, and we got the license with it, which is one of the most valuable licenses in the country now. We've also now realized that we have been able to think about that license in ways that other people hadn't thought about. One of them is that I can talk about is that we believe that the VA, we have a 4-star general that's the CEO of that company. We believe that we'll be able to get the VA at some point to accept cannabis directly, even though it's not in the research ecosystem, because I believe that the Department of Homeland Security already has it approved. We're just not doing any product to them. So that ecosystem, and that's a big market, and that in itself is back to trying to help businesses, help the industry. This is a bigger thing than just us. I'm not a cannabis user, but I do believe in trying to mitigate the opiate crisis.
Yeah, I completely agree.
I do want there to be regulated cannabis. I don't want kids being able to get. I want there to be age barriers, and I think that there's a massive benefit here that we could start looking at, and something that we should have been looking at for the last 50 years. And so we're excited about that. But there's more opportunity that we realized that we started digging into this license. What's interesting about this particular license is that because cannabis is federally illegal, most licenses, you cannot have publicly traded companies that are U.S. companies domiciled in the U.S. on the U.S. major markets. So the only cannabis companies that are on the major stock exchanges, U.S. stock exchanges, are international companies. And so all of the U.S. listed companies are over the counter or Canadian listings. So what's unique about this DEA license that we have, we can take that public. We're going to take that public this next year.
Now, man, how cool is
On a
that?
major exchange, on NASDAQ.
That's a big deal.
Yeah.
Yeah, and so ultimately, you're just able to cast the net farther and wider.
Yeah. And there's more to that story, and it's a bummer that I can't get all the way to share everything about it, but there's a reason that we have to keep that under wraps because of when it does come out, it'll change the valuation of everything we're working on, and then everybody's going to be tracing every trap that we laid and trying to figure out what it was and how we did it.
Yeah, good for you though. But hey, that's sometimes leading the ship and creating that niche. Like I said in the very beginning, you guys created a niche and you figured it out. And you guys, so that's kudos to Dan too. And I know he's going to listen to this at some point. He's always been that business strategist that has been able to implement amazing new techniques, but he's really compliance driven. He really makes sure that all of the features and all of the things to get from A to B and A to Z really is in place to get it done.
I call him a financial engineer, and he's just a data process oriented guy with principles that he's implementing in that whole ecosystem of what he's trying to do. And he just reiterates and reiterates and reiterates and looks
Mhm.
and tries to find a way to make something happen. And once he has an idea, a lot of people, I think it's more common than people realize of coming up with good ideas. It's the execution of the idea
Mhm.
that you can do it in a timely fashion, raise the capital, and make it profitable. And Dan has done that successfully many, many times. And sometimes in that process of getting to the other side, there's some places where it feels uncomfortable, and your investors may have doubts that we never plan on taking back this much in real estate. Luckily, we had a element built in to be able to stabilize and to take advantage of that situation. But if we didn't have that, we would be in a significantly different
Yeah,
situation
it's
today.
yeah, encumbering the business was unbelievable. And then obviously, because really what you did is you said, hey, we have a special purpose building, right? And we can't just repurpose this thing without burying a bunch of money or taking a hit on the exit, just fire sell this thing. We need to bring in an operator. And so you guys got smart and said, we need to go find the right operators that are real business oriented.
Yeah, let's talk about that for a minute. So
Yeah.
we're tracking through our own portfolio of existing borrowers in our book. We're looking at in our own data company. We've established the means of each license type in each state and each latitude. And the reason I say latitude is that if it's an outdoor grow, or sorry, if it's a greenhouse, we don't do outdoor grows. We only do commercial buildings or greenhouses. Every 1% loss of light is 1% loss in production.
Mhm.
And so the higher up in latitude you go, you've got shorter days, you've got potentially longer days and longer lights, or shorter days and shorter nights. But also you have fog and or clouds, and that's impacting. And so all of this information we had to put into our underwriting, and every borrower that came to us only has the universe of their transactions, or maybe the company they worked at before, or maybe their peers in their area. We have the entire country.
Yeah.
We have seen this happen every single in unlimited
What
license
works, what
states,
doesn't work.
limited license states, and we're watching what's happening. And then we also have the flow of deals that are coming to us, and we're picking up new data points that haven't closed yet necessarily. We can see price discovery on transactions before it's closed, so that we have market comps. We might not have done that transaction, but at least we know what the market, what's out there, and what's happening. All of that data helps us to refine and understand what we're looking at for best practices. And where I'm going here is that as we started taking transactions back, we already knew who the best operators were. So if it's an operator within our book, we would then say, hey, do you want to operate this one for us? We want to try to least amount of execution risk as possible. We don't want to have to operate everything ourselves, but we would go to our own existing people. And if we don't have somebody, we knew who the best people were in the area. We also, because come from private credit, we understand structures, we understand the equity because we had to underwrite the equity, but we weren't operators. And this is where a lot of investors, as we talk about this, say, well, what do you guys know about cannabis? Well, we don't know about cannabis, but we do know what makes the businesses work, but we don't run them ourselves directly. So we know who the best operators are in the country. So we brought on the top advisors to help us. We brought on co-founder of Cresco Labs. We brought on, which is Joe Catalbiano. We brought on Charlie Jackson, one of the most prolific early investors into the sector, son of Phil Jackson. We brought on many different advisors. One of the earliest guys from KKR. These guys have been in the cannabis industry for decades and really refined that process of operational execution and know how to run those businesses. And so we just bring in, as a fund manager, we can't possibly know all the nuances of every single one of these different types of business, different types of licenses in different states and all the compliance. So we just hire the very, very best that we can possibly get for each transaction. We build that team, we build those ecosystems. So back to State House, what the strategy was there is that we brought in who we felt would be the best CEO to turn that transaction around. We oversee it, we make decisions with them, but they're executing and running those businesses at that level.
Oh, dude, I love it. So, and obviously their track record and their history and what they've seen already for being in it for years and years. I'm assuming what you guys are looking at from a numbers perspective, you have all the data points. They're coming in and going, okay, boots on the ground. Here are the deficiencies. Here's how we can adjust. Yeah.
So from our level, we're not the operator, but we can say, look, you are 20% underperforming for what the average is of all of our data. So it's possible. We can tell you it's possible. Now, here's where we think that is the way that we've seen it being done before, and this is how we would suggest doing it. And now you go and execute on it.
Oh, dude, I love it. And your team's getting access to that data too.
Yeah. Now,
Yeah.
Conversely,
Yeah.
we can see somebody that's outperforming by 20%,
Yeah.
and we're like, okay, either way, we need to know what it is. And so when we see that outperformance is just as important as underperformance is just as important too. Is we want to keep reiterating to be looking for those things. But when we see that outperformance, we want to know, is this something we can anonymize and start providing this to our whole book to help them stabilize and be more efficient? Because if they don't do this, they're going to get wiped out by the competitors. And so we want to help them get in front of that. And I'll just kind of share what one of those are, is that we can reduce the cost of labor by up to 90%. And labor and energy are your two kind of largest costs in the sector. And there's
Mhm.
another way that we can get another 20% production out of the crops. And this is now kind of widely known, so I'll share it, is that previously the LED lighting, it didn't work. And it was because nobody had built in what we would call full spectrum of lighting. It was just
The,
LED lighting.
the circadian rhythm, right? The real,
Yeah,
real
so
light.
it's a plant. It's something living, and the regular fluorescent or the regular LED lighting wasn't built for plants. And
Mm-mm.
so the first thing is to put in full spectrum, and most people never. What happens in this industry is people try things, it doesn't work, and then they never come back.
Mhm.
But in reality, a bunch of people tried LED lighting, and it didn't work, and they never came back. But in reality, the guys that were top producers reiterated, they changed it to full spectrum. That started working, so now they're saving money on electricity, which is massive. But we ultimately realized that we could get the lights closer to the plant, and we could put the lights under the plant,
Mm.
and that got 20% more yield.
Are you guys doing like water filtration, air filtration, all that stuff?
Oh yeah, that's all of that is
You ever heard of a company called Delos Wellness?
no.
So Delos, this was a group that we were tied to years ago. Probably actually, believe it or not, right after I opened up Paradigm. There's a company called Delos Wellness. What they were doing is they were chasing down. So they partnered with IBM, obviously, and then they partnered with Cleveland Clinic and Mayo Clinic. And what they did is they were taking all the LEDs and all the synthetic lighting out of homes, offices, all the space, because we spend 70% of our lives indoors. What they did is they went after real synthetic or real circadian rhythm lighting, right? That goes with the sun, all the way to where you wake up. They took human beings and put them in air filtration, water filtration, and all this lighting into the Cleveland Clinic and Mayo Clinic, and they studied them for weeks, like 2 weeks at a time. And they looked at like health-wise, like from from sleep trends, like all the chemicals that your body would create, right? Just like with certain foods and what have you. And they were able to track stuff down to like Alzheimer's and some of these like diseases, how a lot of it can actually be tracked. It doesn't help off of synthetic lighting. And I was really impressed. And I was like, it was funny because I was like, I wonder if they're going to use that for the grow industry, because that's exactly, and plus, and air, right? And then obviously water. So I was wondering if you guys were probably,
So
knee deep in all that.
all of that is
Yep.
so the original industry was basically created what we would call the illegal industry. We call it the legacy industry. And
Good way to say it.
you basically have guys that originally were just growing outdoors and just trying to figure it out and making it work. And then they started moving to their mom's basement, and they weren't from the ag industry. And trial and error, and some of those guys are some of the best out there, and
True.
they've really figured it out. But they didn't have the experience from big ag, from mainly the ornamental industry is what would be most similar to cannabis in the sophistication of growing. And so they didn't know, how do you scale something from your mom's basement at, maybe 100 lights to 333,000 square feet with, the scale. And they didn't know how to implement those systems and to refine those processes and things that big ag had learned a long time ago. These guys figured it out on their own, but they didn't know why. And so, and they didn't know what things were so important. But they they landed on it somehow, but they didn't know that that was the variable that was changing it. So today, we were one of the first to bring in a PhD ornamentals guy. And this is kind of an interesting story. So normally when you underwrite a transaction, let's just say we were doing a loan on a furniture commercial building. We look at the financials and to see that they're doing fine, and you're going to make that loan based on his on the business financials and their the appraised value. Well, in this industry, we realized that that's not enough. We actually need to go in and review his furniture building processes and the SOPs and look at the entire thing, because we need to make sure that they are set up to be competitive with their peers. And if they're not, and remember, everybody is starting on their own path, so there is no, there really aren't some best practices. Now over the years, there's some stuff out there, but we had to go in and start having our underwriters send in our cannabis reposition team on the front side to let us know, no, this building, the roofs are too low. They're always going to have a humidity problem no matter what they do. And they don't know it yet. And you can't tell somebody that's already 10 million in that, look, guys, you're always going to have a problem with this. And until you solve for this, you're going to be less efficient over time.
So yeah, air filtration is all going to be important.
So
what about buildings, like building compliance, like to city codes and stuff of that nature?
So
Fire,
sure.
fire protection.
Yeah. So think about this. Plants feed on carbon dioxide, okay, and produce oxygen. So in our indoor cultivation, part of the things that we're solving for is not only lighting and humidity, but also we're solving for, we can get more yield out of those crops by injecting carbon, CO2.
Wow.
Now, the problem is that CO2 is toxic to humans.
Yeah.
Excuse me. And so,
bunch of people falling asleep in there.
well, so, and the thing is, you wouldn't notice that that's the case. And so, all those sealed, hermetically sealed rooms with only one door, and no windows, have to have an alarm. And these facilities are built at. When you go into our facilities, if you look at our website and some of our pictures or videos, you can see that it looks like a lab facility. I mean, they're wearing lab coats and they are top tier facilities. It's just the product happens to be a plant in there. So all that stuff is factored in, and that those we had
contamination, all that, right?
One facility that we were the lender on, the alarm failed for. But nobody knew. It just went out and didn't indicate that the room was toxic, and that becomes a problem, obviously. So you've got to watch out for some of this stuff.
Yeah. So and then all the way down to contamination, soil, all that stuff, man.
Yeah, and it's way more
super scientific.
It's super difficult to manage, and each of these rooms could be $600,000 to $1 million of gross revenue per room. And if you have a contaminated crop, you have to frickin' wipe that whole room. And it also messes up the whole sequencing. So basically you'll have a facility that might have 8 different rooms rolling sequentially. Every week, one room is dropping. And so that by the time that whole 8 weeks goes by, you're just on a continuous flow of product all year round. Right. And so if you have one that fails, it throws out your whole sequencing and it becomes a problem.
What about elevation? Pressure.
That's the first time anybody's asked me about that.
Well, the reason I ask is I have a lot of friends that are going up, they're like Tahoe guys. They go up to Tahoe and they're snowboarders, right? And they're kind of but they like to grow up there. And I didn't ask until it just popped up to my mind while you're talking, going, I wonder if that's a thing.
So I could ask that question from our PhD guy, and I'm sure he would have an answer for me. I don't know how much elevation has to do with it, but I will tell you that the climate from Humboldt being one of the main areas, and we have a facility up there, is relatively close to sea level. I suspect that you're not going to go too high up. And I do know that some states that you're going to the basis is going to be higher in that state, but I don't have the answer to
Isn't
that
that kind of crazy though? Because certain plants won't grow based on elevation. So because this is such a sensitive and everything's so scientifically
I mean,
designed,
it'll
well,
probably
different
grow. It's
relationships.
just the yield would be down, and so that's part of that. But I don't have that. That's
Yeah.
one I haven't. I'm sure I can get
Now
an
you're
answer
gonna
from our
you're gonna
team.
get back in the car and then we have like, I wonder. Ryan asked me about that. I wonder if that's a thing, you
Yeah.
know. But that'd be. I'm now I'm curious.
Well,
Just let me know.
I'm sure it's a thing because there's less oxygen higher up. So I think it's an incongruent. The higher you go, I think the less production you're going to have.
Yeah, I was gonna say. I'd say I probably. What is it, Joe?
It says higher elevations, the atmosphere is thinner, plants receive more UVB radiation, so therefore more THC, thicker resin, and stronger terpenes.
So in essence, higher. So what Joe here, our video editor here, and our research team in the back end here is saying that in essence, with higher elevation, higher THC. But does it have anything to do? So in essence, it's better. But does it say anything about like the speed in which it's produced too? Because that's a big deal.
So as elevation increases, the air pressure drops, oxygen availability decreases, so lower oxygen equals slower growth. So it really,
Yeah.
I guess what it's trying to say is higher elevation is better for thicker.
So ultimately, higher elevation is better.
I don't. I
Is that
I disagree.
ChatGPT?
I think that it,
It depends. So
Yeah.
for instance, your facility, if it's built,
if it's indoor, you're not going to capture the UV and all that stuff. And so now you're just at an elevation that has less oxygen. So
Yeah.
so when we're in a closed facility, we can adjust the oxygen. We would be adjusting.
control.
We would be adjusting the CO2. And theoretically, we could pressurize that as well. And in fact, just so you know, we do have the facilities pressurized so that it is negative pressured outdoor, so that we're always pushing any door that opens, you're pushing
going
out,
out.
so that any contaminants.
So you're constantly pushing air in
And
essence.
you'd be shocked at how easy it is to contaminate the plant.
I know. I hear horror stories.
Every time you enter, you're going through a foot bath, and you're wearing. We have to suit up and all kinds of stuff because it's just microbial stuff. Then becomes it just starts going crazy in there.
It's like it's a virus. It's like a pandemic.
It's a micro pandemic.
It's a micro pandemic just for plants.
Essential workers was the word I was trying to
There you
work
go.
for before.
Okay, so to sum this up, what would you like our audience to know and to build awareness for your investment opportunity? Let's talk about that right here. What would you like to
Sure.
pitch?
So, Polaris Capital Group is a specialty asset manager platform. And, we're here to bring a alternative asset type to investors that they probably don't have in their portfolio.
Which, by the way, alternatives is where it's at right now.
Yeah.
I mean, the
and-
volatility in stocks and so forth, people are stressed out, tired, calling me all the time, going, I'm tired of waking up stressed out.
And if you're looking for an alternative asset class that is positioned to capture the upside of a sector, I think that this is a pretty compelling argument. And we're not here to pitch anybody. We're just here to educate. And we will be rolling out more and more series of educational videos and information that shows these assets. We do tours of our facilities, and we just show you what it is that we're doing. And if it's interesting, we're available.
I love it. Cool. Right on. And so you're moving it. You guys are looking. So you have small family offices. You probably had a bunch of big family offices trying to reach out to you, but you like more of the smaller retail investors that really get an in-depth knowledge, right?
Yeah. So in reality, because of the compliance risk that asset managers perceive as being in this sector, even though we explained to them there is no prosecution in the sector because it's been defunded. We actually did bring in institutional investors, and we showed them how to get in through our structured financial products that we do. But what we learned over time was that anytime you go into somebody that has an attorney in that decision group, the attorney is not participating in the yield, and so they only have there's no power in saying yes for them. And so we try to start with their compliance people first to show them that. Look, if BlackRock and some of these other asset managers are in the sector, you're probably okay too.
Yeah.
And we show them that they're already in the sector. And so, but basically, we've realized that in reality, for where the sector is at today, that retail is what we prefer to work with. And as it becomes bigger and bigger, We do have family offices. We're talking with one of the larger ones that I mentioned to you last night, but it's taken almost a decade to get them to where they're comfortable. And this is a very, very large one.
Yeah,
And
it takes
even
time.
even in that, they are outside the box thinkers, and you happen to know who it is I'm talking about. But so they have that ability to think
Yeah.
about that way.
hmm
But most of them, it's they bring it to their compliance department, and the compliance department says, well, look, if we had to take this back, we could lose all of our banking stuff. Well, you're not the one that would be taking it back; it's us. And so we can navigate all that. But once you start hitting those series of no's, it's not a good use of our time. So we focus on the velocity of. We're built for retail investors. That's how the fund was structured, was to facilitate for them. And to go back, this particular fund, the Polaris Growth Fund, is not an income fund; it's a growth fund. And the way that we look at it is that as we start to have liquidity events for each of these transactions, you then take all your chips off the table. Your pro rata portion of that, what was invested, plus the upside of the unrealized gain you get at that time. That yield that you pick up would be significantly higher than what an income fund would be.
You know what? I think this is important for people to know. One of the things that, one of the reasons why a lot of our investors want to invest with us is because, like, for example, let's say they go into the secured income fund. That's a lending fund, right? Short-term bridge loans. It's, all secured by real estate, note, deed of trust, whatever. The reason why investors like that is because they know I'm willing to get my hands dirty, foreclose. You guys are obviously as well. You guys have a lot more experience than I do. However, you guys are hands-on. You guys will physically and focus on repurposing that asset to save the investors, but also figure out a way to make more money. That's exactly what's gone on here. And that's what's happened with us. Because we're developers as well, they know that, hey, you're giving me an opportunity if you foreclose. Unfortunately, we don't want to. That's not our goal. We want to just make our yield, get our investors paid, and move on. But if we have to get our hands dirty, we're comfortable in that space, and we have the resources and knowledge to repurpose that asset and exit it, and obviously and hopefully make some money. So that's a difference between fund managers, and I want a lot of people to understand the difference between most fund managers that have a strategic business strategy, and it's usually if something goes bad, they really don't have the mechanisms in place or have an understanding of what
Or
they have to do
experience.
or experience. Yeah, like you said, name a fund manager that's actually gone through a couple, downturns, and what did they learn from that, and what are they implementing now? So the fact that you guys are encumbering businesses along with the license and the real estate, but you guys really lent on the basis of the real estate is key. But you nailed it, like special purpose vehicles, special purpose assets. Like it's a science in essence, literally on everything you're doing. But it takes a lot of mental horsepower and it takes a lot of time to perfect that approach. I respect you guys completely because I can only imagine.
Massive bandwidth.
Yeah.
And we've built a team. I started off earlier of what we learned, and we try to have just the very, very, very best core team, and then third party everything out. So now we have a team of 12 that are some of the top analysts and people in the sector that have really learned the industry with us, and we're part of the whole process. So they really understand it, and have really come up with some innovative ways to be thinking about things. And also, the other thing I would say is relationships. If you don't have relationships, you're not going to, I don't care how good you are, if you've burnt everybody in the industry, we wouldn't be able to execute on the opportunity we're doing right now.
Yeah, we talked about it on the way here. When you guys as a fund manager have an operator that's not performing but is willing to communicate with you and spill the beans on what their hurdles are, you guys step in and help them. Where if they're like, I do it too. If a borrower comes to me going, Ryan, I'm having a hard time, I had to fire my contractor, can I get an extension? You bet, no problem. I'll give you an extension. Make sure you come current, whatever the case may be. But if you just go dark, I have no other option but to foreclose on you. So it's really that relationship between their lender and the operator is unbelievably important.
We actually probably see it. We know what's happening probably better than them because we start to see it in their financials. So they're required to provide quarterly reporting, and we can start to see the numbers go down. And we might say to them, "Look, your labor is not in what is market to everybody else." In fact, we found a bad actor that way. It turned out that he had 2 facilities, and that he had moved all of the employee payroll to the facility that we were lending on, so that the other facility that he had better economics in was free and clear. And the way that we discovered that was from doing our analysis of what the costs were per employee. And then when we saw it wasn't adding up, we started using satellite photos to look at the parking lot to see how many cars were parking there. And we kept calling him and saying, look, we've got a guy doing a drive-by today, and there's nobody, we don't see any cars there. We weren't telling him how we were inspecting it. And said, oh, today was a day off, or we had a power outage, and so everybody wasn't here today. And we're like, okay, well, what about the day before? Yeah, well, that was a normal work day. We're like, yeah, no, it wasn't. And
Wow.
so we stand, once you break the credibility with us, then it's you're considered a bad actor.
Yeah.
And, people start doing desperate things at desperate times.
You just have to get in front of it.
You got to get in front of it.
Mhm.
And so in that particular circumstance, we immediately put that in receivership instantly without telling him. And
Mm.
so the next day, doors are on, he's locked out.
Wow.
Yeah.
That's the way it goes.
Yeah.
Gotta be honest. That's the way it goes. Well, Rob, thank you very much, man. This was killer. I think this is gonna be one of the most watched and listened to podcasts I've ever had. Very sophisticated. Obviously, you were my mentor. Everyone always wants to know where the hell I came from. And I tell them I'm a little spot in Orange County somewhere. But I love you, man. Thank you for being here. I appreciate you coming out here, spend the night with me, and just recalibrating and reconnecting with you and hearing all the stuff about Dan. Until then, I love him. I'll call him. I'll text him.
Will do.
I'll give him a ring.
This has been awesome. I look forward to coming back and seeing where the projects are for
Cool.
you next time I come.
Well, I think some of our network's going to see more of us. I'm gonna build some more awareness for you guys. I want my team to really consider, investing into you. I think a lot of other fund managers go, oh, I don't want my investors to invest in other people. Well, that's not. I want my investors to win. I want them to diversify. I don't want to have them put all their eggs in one basket, right? So I'm only going to represent the best of the best, and that's why you're here, man.
Great. Thank you for having me.
Cool. Thank you, buddy.